Okay, 8:32. If everybody's sitting comfortably, then I will begin. Good morning, everybody, and welcome to the BHP review of the budget 2021 and to the BHP boardroom. I think we've all got used to webinars and Zoom calls and doing things remotely, but it still feels extremely strange to me to be sat in a room on my own talking to what could be up to 200 people. I'd much rather be sat in front of you and seeing you face to face, and particularly as I think probably Budget 2020 review was the last formal corporate event before we went into lockdown, and probably the last time that we actually attended an event together. So we hope that at some point we'll return to normal, but for the time being, Zoom and a Zoom webinar it is. For those of you that don't know me, I am not a cat. I am a real man. My name is Chris Humphreys and I am the head of tax at BHP, and it's my role today to talk you through the budget update yesterday and to give you a steer on where we think budget policy is going and measures that you might like to think about. You'll be pleased to know that whilst there are two of us on the screen, the intention is that it's not going to be like the regular government updates. If I say the words "next slide, please," or "we're following the science or the data," then Zoe has instructions quite clearly to cut me off and to take me off from the webinar. And the process today is that I will do the presentation. Zoe is my quarterback. She will be fielding the questions. So if you want to post them into the chat room or into the Q&A, she will head them off. Maybe corral them into a group so we can deal with them at the end. But if she feels it's relevant, then she'll interrupt and we'll pick it up as we go along. Katie Hall, our marketing support, is sitting in the background, making sure I don't kill the technology. But generally, we hope it's going to flow nicely and we'll give you a real steer on what the Chancellor introduced yesterday. And I suppose, by way of introduction, if you get the impression I'm a bit jaded and a bit cynical about sort of government information and the way it's released, then I'll give you a steer by virtue of the fact that I'm a great fan of conspiracy theories. So as far as I'm concerned, you know, Lee Harvey Oswald never killed JFK, America never landed on the moon, and Elvis is quite happy flipping burgers at some pace in Blackpool. He does do it very slowly now by virtue of the fact he's 86. But generally, I think the way in which government now releases information and imparts it to the public is actually as important now as the information itself. And if you think only of Prime Minister's briefings, you know, when we get the announcement that Boris Johnson is going to tell us the roadmap out of lockdown at 7 o'clock on a Friday night, we know full well that by 5 o'clock on a Friday night, we'll already know what's in that speech and what it's going to mean. And I think actually yesterday, the Speaker said, just before Rishi Sunak stood up, that he already knew everything that was in the budget. And that's really frustrating for a sort of budget commentator such as myself. On the slide, you'll see my list of what I think the budget leaks were. And we'll probably come back to most of these during my presentation, because if I placed an accumulator on most of those, I'd probably be quite a rich man. And it seems bizarre that in a world where in 1963, a Chancellor actually resigned on the basis that a budget was leaked, we're now in a position where most of the budget is released in advance of the Chancellor stepping up to announce it. But we'll come back to quite a lot of that as we go through the presentation. I think what I will say on reflection is that the budget yesterday was a very eloquent and well-presented budget. It was touted as a budget for the now, a budget for the moment. So it was really a very, very different budget and reflects the fact that, you know, it's only 350 odd days since a budget just before the lockdown. And a really strong, robust language by the Chancellor, you know, to do whatever it takes, almost getting to the sort of motto from the US Marines where we never leave a man down. But words such as honest, determined, fair, generous, promises, really robust language that reaffirms his stance about how he wants to deal with the pandemic and the economy through that. Three clear stated objectives. The first one being to protect jobs and livelihoods in the continuing battle against COVID-19, to secure the economic recovery and to fix the public finances. But the question for all of us is when and how and at what point do we deal with 1, 2 and 3? And how actually do you balance these 3 objectives? And I think in delivering his budget yesterday, the Chancellor made it clear that actually we're still dealing with objective 1, and that all we can do at this stage until we're further on is to set the groundwork and the planning for objectives 2 and 3. And I came away thinking that actually this is a man that's on the trajectory for a Prime Minister role at some point. And there was an interesting sort of presentation or TV piece before the budget speech, which actually said that nobody had a bad word to say about him, which is unusual about most politicians this day. So a clear 3 objectives, with a view that actually number 1 was the most important and number 1 that was the one that we were still dealing with. And to put that into context, this is a slide from last year's presentation from Budget 2020. Similarly robust language and a very sensible approach to the start of the pandemic. At this stage, we hadn't even got into delay phase to stop people getting into swamping the NHS. And at that point, we believed that the total of the measures was £12 billion. And even with a bit of double counting, I think I could only get up to 30 billion. And yet we discovered yesterday that the scale of the government intervention is likely to be of the order of about £360 billion by the end of this financial year and £407 billion by the end of next financial year. So the scale and depth of the government intervention is huge and unprecedented since World War II. And it's the scale of that intervention that actually suggests that the UK economy is probably doing a bit better than we anticipated. It has contracted by 9.9%. That contraction actually isn't as much as we anticipated. And we expect there to be a 7.3% bounce back next year, followed by growth at around the 1.7, 1.6% rate. The expectation is that we will return to pre-COVID levels by 2022, 2023. But when we get there, we'll still be 3% behind where we thought we would have been if we just carry on as normal. So better than anticipated. Unemployment is at 5.1%. Now, probably 2 or 3 years ago, we would have said that 5.1% was acceptable. So it's not unusual. It is, however, the highest level since August 2016, with 4.7 million people still on furlough. That's 4.7 million people who were employed by the government. And that is the cliff edge that the government is really worried about. The expectation is that unemployment will peak at 7.5% later this year. But in the absence of government intervention and structural change for places like hospitality, retail, tourism, the cliff edge for unemployment would be unsustainable and unacceptable. Inflation is bubbling along at 1.5%. It's increasing to 1.8% in 2022 and reaching target, we think, the target of 2% by about 2025. So I'm not really concerned about inflation. Unemployment is the main worry at the moment. Government borrowing is huge. The deficit is 355 billion. Total government borrowing is about 2.1 trillion. It's the highest level as a proportion of GDP since the 1960s. But I think we're okay with it at the moment because the cost of borrowing is currently low. And for somebody whose idea of fiscal management is a 0% balance transfer to a card with 36 months no repayments, I think in some ways that's how the Chancellor views debt borrowing at the moment. It's sustainable, it's affordable, it's acceptable in the context that we need to do whatever it takes and to spend whatever it takes. The key thing in the speech yesterday was that its tolerance is pretty limited in that an increase in interest rates of 1% or inflationary pressures of about 1% increases the annual funding cost of that debt by about 26, 27 billion pounds a year. So at the moment, it's relatively cheap. It could become expensive. And that's why some of the measures and the plumbing that were announced yesterday were about setting the base of how we address government borrowing going forward. And certainly the expectation is that percentage, 99.4%, will reduce significantly over the next 4 or 5 years. Interest rates, tend to forget about them really, reduced to 0.25% on last budget day. And Actually, it might have been the budget day before that. You lose track of where we are with interest rates because they've been so low for so long. And there's no expectation that they're going to increase in the short to medium term. Which leads us to the scale of the intervention. And I have no apologies here for sort of setting out some of what we know already, and then from that to drive into what was announced yesterday. We're all familiar with CBILS, Coronavirus Business Interruption Loan Scheme, and with bounce back loans. Still available to apply until 31st of March 2021. But the inference with both of those is that the repayment terms can now be spread over 10 years rather than 6. And certainly repayments, whether interest on capital, are deferred for either 12 or 18 months. And around that, there are still provisions within bounce back to allow you to take interest-only payment periods of 6 months, 3 times during the term. So it's all about deferral and pushing on and paying at some point in the future. And a similar theme with regard to VAT deferment. VAT payments have been deferred by many of us between 20th of March and 30th of June 2020. The original intention was that these had to be paid in full on or before the 31st of March, but you can now opt into a deferral scheme, which opened on the 23rd of February and will continue to the 21st of June 2021, where you can agree payment terms with the government and HMRC to extend payment over a longer period. So again, pushing it on, allowing the recovery to gain momentum to the point where we can afford to pay it. So CBILS have gone. Or will be going, and bounce back loan will be going to replace by what was announced yesterday, the recovery loan scheme. So this is about coming out of the pandemic. This is about funding growth and recovery, allowing us to recover from the impact of what's been a very difficult period. It's going to be launched on the 6th of April 2021 and will be available until the 31st of December 2021. Any business can borrow of any age and any type, and borrow between £25,000 and £10 million, with 80% capable of being covered by a government guarantee. There is a fee for that government guarantee, but it will give lenders and Virgin Money, Lloyds, Barclays have already registered for this scheme, the ability to lend under secured terms with no PGs up to £250,000, and the protection that a borrower's principal private residence cannot be taken as security. So that's quite an important next step in driving recovery in the economy forward. I've talked about structural change for hospitality, tourism, retail. So a £5 billion fund to support the high street and to enable them to reopen and to reinvigorate what has been a significantly long closed period. The expectation is approximately 700,000 businesses will be eligible, and depending upon the type of business, you should be able to claim between £6,000 and £18,000 of grant funding from the government. So another step in re-engineering what the economy looks like and trying to get us back to a normal. I suppose the next one I struggle a little bit with, because to be fair, I see sport as being at the back of the queue for things that need addressing, particularly having watched Sheffield Wednesday play Rotherham last night. So £300 million to save Silver Sport, plus up to £1 million, it should say there, to rescue local pubs and football clubs. Again, going back to Sheffield Wednesday, I think £1 million might well be enough to buy it, given what happened last night. And then £400 million to support theatres, museums, galleries and live music venues, which really have been hit hard by the pandemic. So a lot of money. And again, it's whatever it takes to make sure that we come out of this in the right way. Another feature of that, I think a lot of hospitality and retail businesses have benefited from the rates relief, which basically reduced their rates bill for the year. I sort of got the idea that this was coming because businesses I'm involved with in this sector haven't actually received their rates bill yet. And I think the premise is that you will get 100% rate relief to the end of June 2021, and that will then be discounted to 2/3 of the normal charge until 31st of December 2021. The expectation is that the cost to the Exchequer of that is about £11 billion. A large amount of that will be funded by rebates from the large supermarkets, so Tesco, Sainsbury's, have claimed rate relief initially, and will now all be repaying that back to the government. So that funds quite a large proportion of that. Other measures, mortgage guarantee scheme for first-time buyers. This is to encourage lenders to provide more 95% market mortgages. They've largely disappeared from the marketplace. We need to get referred to as getting people away from renting into buying, and certainly that is a big hurdle for young people at the moment with smaller deposits. So hopefully that will free up the property market. The £20 per month uplift in universal credits to be retained, that's worth £1,000 a year. Could have announced that earlier. I mean, it was leaked, but actually in terms of somebody claiming universal credit, I'd probably like to have known that a bit earlier. And then again, the fact that this was a budget for the now and the moment led to the fact that there was, I think, one mention in this budget of the NHS. I struggled to find it, but certainly the Common or Garden budget always talked about NHS, schools, education, transport. Nothing of that whatsoever in this budget. It was wholly a budget looking at securing and protecting people's lives and setting the groundwork for a sort of a recovery going forward. And know the furlough scheme really, really well. And one of the main tenets of government support over the last year has been the introduction of the furlough scheme. All credit to the government for introducing this and for writing a software package that literally was able to introduce significant support to businesses with probably what was a 4-week period. So the furlough scheme version 3.0 has been extended to the 30th September 2021, which means that the government will now cover 80% of wages up to the end of June 2021, up to a maximum of £2,500 per month. That's where we are at the moment. That support will then taper away with 70% government support from until 31st of July 2021, and then 60% government support for August and September. The balance of the 80% has to be paid by the employer, so you'll be topping up either 20 or 10%. The idea being that we will have not a cliff edge, but a slow return away from furlough, with the costs being split between the government and the employer. The extension of the scheme is a great introduction. It gives certainty for lots of businesses and allows us really to push on the structural changes to hospitality and retail to a point where they've recovered and can understand what their business looks like at the point that they bring people back from the furlough. My real worry about the furlough scheme extension is that it will mean that there are people out there that have been furloughed for 18 months. And the mental well-being and self-worth of those individuals must be at risk. And whilst there were announcements yesterday about support for mental well-being of veterans and for domestic abuse, I really think there needs to be a really strong lead from this government about supporting mental health and well-being of people that have been on furlough for significant periods of time. That would be quite important for me. The cost of the extension of the furlough scheme is about £5 million per month. So it's not insignificant, and it reflects the focus, as Rishi said, of jobs, jobs and jobs. So it's a good thing, but no reintroduction of the job retention bonus. If you recall, this was to be £1,000 per employee, where you'd furloughed somebody but return them to full employment, and I don't think that will ever return. This is all about coming slowly out of the furlough scheme into full employment, and there is a stick out there in that £100 million was announced as the funding for additional resource and support for HMRC to audit furlough grant claims. Now, the budget speech alluded to the fact that this was fraudulent grant claims, but I think also it will cover mistakes, and they will be looking to audit all grant claims over a period of time. And whilst the acknowledgement at the start of the furlough scheme was that mistakes could be made, I think they will be looking to correct the position. So anticipate some fairly details from letters from the Revenue at some point in the future. Naturally, we'll be able to help you with those, but it's likely that that's what the groundwork for the next year or so is going to look like. Alongside the furlough scheme runs the self-employed income support scheme. I'm calling it version 5.0. I've probably been less involved in this over the last 10 months. It seemed to move more automatically than the furlough scheme. But effectively, grants for the self-employed will continue, with the fourth round of grants keeping the same terms as the earlier version. which means that the grant for February, March and April will see the government cover 80% of average monthly profits up to a maximum of £2,500 a month. It's paid in one lump sum of £7,500, and it sort of tries to level up the distinction between self-employed and employed. There was a loophole, though, which said that actually if you hadn't traded in 2019, 2020, or made a tax return for that period, then you couldn't claim. So that loophole's been addressed. So people who became self-employed in 2019, 2020 will now be allowed to get grants under the fourth round of grants and also the fifth. And that is a loophole that will provide a boost to what we think is around 600,000 people. So not insignificant, and an anomaly that we're pleased that's been closed. The fifth grant is slightly different, can be claimed from late July. It relies on the extent to which your turnover has been affected by COVID. So 80% of monthly profits capped at £7,500, where the reduction in turnover is 30% or more, but 30% of monthly profits capped at £2,850, where the reduction in turnover is less than 30%. So a bit of clarity there, and again, an extension of a significant intervention until the end of September. So we now come to some of the things we probably knew were going to happen. And that were leaked in advance of the budget. So the personal allowance will increase to £12,570 from the 6th of April 2021. The limit where you start to lose it is retained at £100,000. So at the point that you have an income of £125,140, you will lose all of your personal allowance. There is no change to the income tax rates. And the level at which you become a higher rate taxpayer will increase to £37,701. Having got to those levels, those rates and thresholds are then frozen until the 5th of April 2026. Now, that's a great example of stealth tax. It means that approximately another 1.5 million, I think it was, taxpayers will come into the tax net that otherwise wouldn't. And it will raise £6 billion by the time of the election in 2024. And I think about £8 billion by the end of the next 5 years. So it's one way that the Chancellor is looking to support the Exchequer and the recovery. It does lead you to a general theme on rates and allowances, and actually got the government to deliver on their manifesto commitment and the triple lock, in that all of the following are frozen until the 5th of April 2026, which is the rates and thresholds for income tax, as we've just talked about, but also for national insurance, the VAT registration and deregistration thresholds, which I'll come back to again. The lifetime allowance for UK tax relief pension schemes will remain at £1,073,100. In terms of pensions, the good news is that higher rate tax relief is still available, and the annual allowance remains at £40,000 before it starts to get tapered away. So corporation tax, this is where it starts to get a bit more interesting, a bit meatier. The headline was an increase in the rate of corporation tax to 25% from the 1st of April 2023. And I think the comment from the CBI yesterday was that that was a bit of a sharp intake of breath, and that large businesses were effectively footing the bill for the pandemic. I don't really get it like that. I think the headline had been leaked well in advance. I think if it was any tax that was going to increase, it was probably a popular one to increase. The idea being that if you're making profits, then probably you're doing all right. If you're a large business, you're probably able to sustain the pandemic better. And the idea that it wouldn't impact smaller businesses or businesses that are making losses is a good one. It still means that we've got the lowest CT rate in the G7. I don't know how clearly you can see this chart on your computers, but partway along the right you can see the UK, and the green bit shows where we'll end up. The blue bit is where we are at the moment. So significantly low at the moment, one of the lowest rates around, but even with the increase, we will still have the lowest CT rate in the G7. And if you look below, the countries that have more competitive CT rates, corporation tax rates than us, are Hungary, Lithuania, Poland, Estonia, Iceland, Slovak Republic, Sweden, Norway, Israel, Luxembourg, Belgium, and the Netherlands. So I would argue that our major competitors whether it's US, Canada, Italy, Spain, already have corporation tax rates that are higher than us. So we're still competitive in terms of a place to do business. It's interesting how it's going to work in practice, because one of my colleagues, Dean Pearson, yesterday commented on Twitter, I think it was, that it takes him back to his studies probably about 10, 15 years ago. It certainly reminded me a lot of it, and I can see that Zoe's laughing as well. The unified rate of 19% will continue until the 31st of March 2023. It will then be increased to 25% from the 1st of April 2023 for companies with profits in excess of £250,000. So we're back to a different rate for large companies, something we had many years ago. The rate of 19% will remain for companies with profits less than 50,000. So small companies will still have a different rate. But the issue is the gradual increase in between, because at some point you've got to increase your tax rate from 19% up to 25%. So what it actually means is that the marginal relief calculations that we were used to doing years ago are back, and that the rate in between the 50,000 and the 250,000 pounds will actually be a penal rate, which will be higher than 25%, because you've got to play catch up. So happy days, because we're back to the old idea of where do you allocate your group relief to, and how do you work with your management charges to reduce the incidence of tax, and making sure that the effective rate of tax across your group is as good as it can be. The limits above are divided by the number of associated companies. And again, it seems to me that on the definition of associated companies, we're back to the old rules. They were amended to include only 51% subsidiaries. Let me get rid of that. Now that's being changed to cover any company that is controlled by a person, the same person, or controlled by a number of the same persons. So back to the old days of looking at associates and shareholders and who controls what and what's the link between the two. So probably not as clear cut as it used to be. And then finally, and I've not done the mathematics on this, but historically, over the last 10 years, I think we've tended to rest on the idea that a minimal salary is best topped up by a dividend, because that gets you your best effective rate of tax. Whether that will now change, given that the rate of corporation tax out of which those dividends are voted is increased, we'll have to work through. But it might mean that you need to revisit all those calculations. Okay. The other big thing on corporation tax, the other headline was that the enhanced ability to carry back trading losses. So the rules as they stand at the moment is that you can currently carry back a trading loss for 1 year without limit. Now, if you have been impacted by COVID with a significant loss, it might be that actually you can only get relief for a small part of that loss. And so what the rules we expect that they'll look like going forward is that for companies, the carryback is now extended for losses incurred in accounting periods ending between 1st of April 2020 and 31st of March 2022, and that you can now carry them back a further 2 years. So if you carry back into the previous year and you've still got unutilized trading losses, you can now carry them back into the preceding 2 years up to a maximum of £2 million. It's profits against the same trade, unfortunately, but it should mean that you will be able to enhance your carryback claims and achieve an additional cash flow benefit. The figures in the budget book yesterday said it's an additional £760,000 worth of tax repayments, which I think is 2 times 2 million at 19%. But it obviously depends on the fact that you've made that amount of profits in the preceding year. So obviously you'll need to do the calculations. For an unincorporated business, the carryback is extended similarly, and that carryback goes against general income, so it's a bit wider, and it's in relation to trading losses in 2020-21 and 2021-2022. There is also still, however, the £2 million cap. But generally, it takes us back probably about 7 or 8 years where a 3-year carryback was possible. If you're in that position, it could well mean that you get earlier relief for your losses with the enhanced cash flow benefit that delivers, because in the absence of this carryback, you would just have to carry them forward and set them off against your first available trading profits. So interesting stuff on corporation tax, which leads me nicely to the second headline from yesterday's budget, which is the super deduction. Great term. Now, I suppose we all knew that the annual investment allowance of £1 million had been extended to the 31st of December 2021, which was good news and gave us certainty on investment decisions. And the general feeling was that 99.9% of businesses would get full tax relief for their capital expenditure. From the 1st of April 2021 to the 31st of March 2022, this is enhanced in that you can now claim 130% super deduction on qualifying plant and machinery, and that is uncapped. In support of that, there is also a 50% first year allowance for qualifying special rate assets. So that's cars with higher emissions, integral features in buildings. But generally, quite pleased to see this. I'm a bit confused about how the annual investment allowance works alongside the super deduction. If we go back a slide, and the reason is that if you've got the annual investment allowance, you're getting 100% relief. That's always there up to the end of December 2021. If you're spending expenditure on plants, then you could have the 100% deduction, but in effect, you can now claim the 130%. So you probably go for the 130%. And then I think the other thing to point out from this, and Zoe reminded me of this morning, is that this super deduction is only available for corporates, for limited companies. So it's not for unincorporated businesses. And then the other part that I need to get my head around is that the special rules apply to the sale proceeds. So if you have an item of plant on which you claim 130% super deduction, then at the point you sell it for proceeds, you will also have to gross up the proceeds at 130%, which means that you're then comparing like with like, which seems the right sort of logical thing to do, and probably means that you've had the right amount of allowances in the middle. So there's quite a bit to work through on that, and I spent a lot of time last night trying to find a bit of detail to it, and it's not around at the moment. So I'm hoping that we'll get a bit of clarity on that over the next couple of weeks. All right, moving swiftly on, and this is at the back of the budget announcements. In the R&D is still at the forefront of the government's plan to support businesses in investing in plant and machinery and innovation. And the intention is that the investment in R&D in the UK should be increased to £22 billion, with the target being that it's going to get to 2.4% of GDP by 2027. And where we stand at the moment, large companies get a taxable credit of 13% of qualifying R&D costs. Small and medium-sized companies get an additional deduction of 130% of qualifying costs alongside their normal deduction. And if loss-making, can surrender that for a 14.5% tax credit. So it's a relief that really does work and has enhanced the cash flow of many businesses that we're involved with. From the 1st of April 2021, there is an abuse rule coming in which says that the cap on repayable claims by SMEs that is applied to the effect that it's 3 times pay as you earn an NI in the previous year. So that's something you need to be aware of. But generally, what the government are doing at the moment is consulting on the future of R&D. Should the two schemes be consolidated? Does the rate of relief impact your investment decision? Could R&D be used to incentivise research in specific areas? So green technology, decarbonisation. It's quite a detailed consultation document. It asks a lot of questions. And I think we'll keep an eye on how the direction of travel moves with that. To steer, the ability of people to claim. What I expected actually was a wholesale increase in the rates. I think we've talked about this before, and the R&D relief is effectively was EU support and had to be harmonised across the EU. But to the extent that we're now outside the EU, there's no reason why we can't increase our rates. So I think a harmonised scheme, consolidated scheme, would be good. If the answer to the rate of relief, yes, it does impact your investment decision, then I would hope that the government would move quickly to increase the rates at which relief can be claimed. And naturally, we'll keep you posted on how that moves over time. Okay, take a breath. Capital gains tax. Now, going back to my accumulator on budget predictions, this is where it would have failed and I'd have lost my money. because everything in the press and in the Sunday Times and the Times and the quality newspapers was that capital gains tax was going to increase in this budget. And so the illustration, the picture on this slide is a reference to my corporate finance colleagues and to any corporate lawyers on this call who have spent the last 2 weeks desperately trying to get deals over the line before the budget deadline. Actually nothing happened, nothing changed. Now, I think what was announced is that CGT rates will remain at 20%. And 28% on residential property. The annual CGT exemption becomes 12,300 or 6,150 for trust, and those are frozen until the 5th of April 2026. But there are no changes to business asset disposal relief or entrepreneurs relief, as it's now called, with the lifetime limit remaining at the reduced £1 million. And the CGT exemption on a disposal to an EOT, an employee ownership trust, is still there. Now, I'm getting cynical at my own age, and I'm sort of saying, well, was this a strategic rumour? Because the impact of the pre-budget rumours was accelerated transactions and additional capital gains tax for the Exchequer. So stick that rumour, see the pond and the ripples go out, and all of a sudden money flows into the Exchequer. In a way that probably it wouldn't, because the one thing about CGT is that it's a tax you can avoid by not selling anything. So I do think it was a strategic rumour, and I do think the impact will be the right one, but I do feel for all of the corporate guys out there who have spent the last month or so desperately trying to get deals over the line. Didn't need to. Quite clearly with capital gains tax, it is, however, on the government agenda. So having got them over the line, that probably is a good thing, because the direction of travel is quite clearly that capital gains tax will increase at some point in the future, and that the rate of capital gains tax will generally be aligned with income tax. We are expecting further details from the Office of Tax Simplification over the next couple of weeks, and I'm going to talk a bit more about consultations later, where we might find out a bit more detail about CGT generally. A similar theme on sort of value-added tax, really, in that one of the frozen thresholds is the registration and deregistration thresholds. They're frozen until the 31st of March 2024, 85,000 and 83,000 respectively. Simon Buchan, our VAT director, reminded me that this had been on the government's agenda for quite a while in any case, because they believe that the VAT threshold is a cliff edge, and you're either in it or you're out, and that generally businesses try and avoid being in it. So at some point, there will be a view on what that looks like going forward. But generally, within this budget, there's not as much as anticipated, but I think it will come. And the reason for that is that I think at the moment we're still struggling a little bit with the practical impact and complexity of Brexit and the transfer of goods, and the impact on VAT, whether it's UK or within the EU. But I think actually it will come, because VAT is an easy and immediate tax to change, and has an immediate and easy impact on the Exchequer. And one of the things that has been touted over the years is that you could increase VAT on luxury goods and take the rate up to 25%, and that would have an immediate impact on the take for the government. So that would be a likely change going forward. Excuse me. What I will say is that there was some good stuff in this budget, which is the extension of the reduced VAT rate to certain supplies in the tourism and hospitality sector. So that will remain at 5% until the 30th September 2021, and then at 12.5% until 31st of March 2022. And that applies to restaurant services, hot takeaway food, holiday accommodation, and admission to certain attractions. And Simon is ready and willing to help you out with any questions you might have on that. One thing that has snuck upon us is the construction industry reverse charge from the 1st of March 2021, which generally has been difficult to get to grips with. It's been deferred a couple of times, and is a bad thing in terms of the impact that it has on construction cash flow. And hopefully you've managed to model through that.
We have got a webinar on that on the 16th of March as well, so if you haven't managed to muddle through yet, you can...
Yeah, and the impact can be significant, Zoe. I mean, our model one, where the fact that you were not able to retain your VAT for the 3 months sort of cycle actually had a £500,000 impact on your cash flow, which is not insignificant. So you need to work through that. Okay, moving on. Inheritance tax reform, nothing. Absolutely nothing on inheritance tax, but just recognising that it's on the agenda. The Office of Tax Simplification obviously reported on IHT and made a number of recommendations to the government. This was followed on by an all-party parliamentary group report in January 2020. That reform is on its way and will happen at some point. But as I say, we've got the moment to budget for the now and for the moment, so it's on the too difficult step, I think. The nil rate band remains at 325,000 and the residential nil rate band at 125,000, both frozen until the 5th of April 2026. And similarly, nothing on stamp duty. We've talked about the stamp duty holiday being extended, which effectively sort of supports the housing market and certainly helps those lawyers that were trying to get residential property transfers over the line before budget day. But other than that, there's no notion of any stamp duty land tax reform. The stamp duty land tax surcharge of 2% on UK residents arrives on the 1st of April 2021. But again, this is something that's getting pushed onto the long grass. And the long grass is arriving because there is a tax day on the 23rd of March 2021. So yesterday's budget was a budget for the now and for the moment. And tax day is a budget for the medium and long term. And within this, we expect to get some idea of the consultations on capital gains tax, where's that heading? On inheritance tax, where's that heading? Stamp duty and VAT. So actually, I think we ought to think about putting another date in the diary for us to reconvene on the 24th of March, because certainly the view from myself and from Zoe and the rest of the tax partners at BHP is that substantive and long-term facets of the sort of tax direction are going to become clear within that document. Now, normally at this stage, I sort of end with a couple of funnies or a couple of flippant remarks, but I struggle a little bit with it, given that we're 1 year into a global pandemic. Many of us haven't actually seen some of our work colleagues for a year. Many of us have been furloughed, and a lot of businesses have been impacted severely. But I will give you a couple. One's highbrow, one isn't. So what's the difference between COVID-19 and Romeo and Juliet? Well, one's the coronavirus and the other is a Verona crisis. So that some of you will understand that. But the other one, which I really like, given the fact that I'm having to watch Death in Paradise at the moment to cheer me up, and from the fact that I can't get away on holiday, is that when Boris Johnson announced the roadmap out of lockdown, my wife and I decided to throw a dart at a map to decide where in the world we'd travel to. No expense spared anywhere. Unfortunately, I'm not very good at darts, so 2 weeks behind the fridge sounds all right to me. And with that, I will leave you. Thank you very much for listening. Hope you found it interesting and entertaining, and we'll pass on to my quarterback to see what questions we've got.
So we have had a few questions come through. This one from Andrew Scott is about the SEIS grants and whether they will apply to the if you're a director and only a sole employee of a limited company. And I don't believe anything's changed on that.
I don't think anything has changed on that. I think it's one of the unfortunate anomalies that hasn't been addressed by the government. And this is a situation which is quite usual, where you've got a director of a limited company where, following good tax advice, you have taken a minimal salary and then topped up your income levels by way of dividend. And dividends are not recognised by this government as being something that they'll support or compensate by way of either self-employed income support or the furlough scheme. So unfortunately, no, Andrew.
Okay. Second one on capital allowances from David Kearns. And he's just questioning how the different allowances interact, I think. So the question is, if CapEx applies for R&D and gets 100% the R&D allowances, is this superseded by the 130% relief, and are there any further reliefs for CapEx that qualifies for R&D?
So that's a great question, David, and I think it's one I'm struggling with a bit at the moment. The inference I get is that you've got a whole raft of capital expenditure that currently would qualify for 100%, either under the AIA or under the R&D rules, or under the fact that, for example, it's an electric car, so it's emission friendly. And the inference I get is that you will be able to elect to take those into the 130% deduction. I think not in relation to cars, but certainly anything else, you'll have a choice. Now, as to whether there's a good choice or a bad choice, I'm not sure at the moment. I need to work through what the impact of the sale proceeds is going forward. And also, I reflect on the fact that actually, if you've got £1 million of AIAs and you've got £1 million of super deduction, that's £2 million of expenditure. I don't think there are many businesses in the UK that are spending that amount on plant and machinery at the moment.
Okay. We've got a question from Sean on education and apprenticeships. Was there any changes there to the support that was coming for apprenticeships?
There was. Yeah, I mean, the dynamic on what we brought into this presentation is to try and give you as much idea of what's around. There were some other things that probably we can bring out. Quite clearly, the government is looking to address the productivity gap. It's been a problem for a while. So I think you've got Help for Management, which is a grant-funded scheme to support management in developing. You've got Help to Grow Digital, which is another government-funded scheme to support people in digital changes. But then behind all that, yeah, the apprenticeship scheme, which is effectively gives you £3,000 for all new apprentices of any age has been doubled. So I think the ability to take on apprentices is improved, and I mean, I think we'll find out a bit more detail and send it through to you if that's okay. But yeah, absolutely, there is additional support there for apprentices.
Okay. But somebody asking about clarifying the income tax threshold, so and how it interacts with the higher rate band. So the question is, if the higher rate band is the higher rate band of 50,000 increasing to 50,000, and I think actually the 50,000 is the interaction with the personal allowance. And
yeah, so if you add together the personal allowance and the 37,700, then you get to, is it 50,170, Zoe? I think it is.
Yeah. 270, yeah.
270, and that's the level at which you start to pay higher rate tax. So it's a combination of the two. And the headline always was originally that it was 12,500 personal allowance and then 37,500 basic rate band. So you got to 50,000 before you paid tax at higher rates. So it has increased slightly, but it's not frozen.
We have had some chunky increases to those personal allowances over the past few years as well. So
yeah, they've jumped up quite significantly. Yeah, agree totally.
Yeah, okay. From James Barrett, has there been any guidance on what qualifies for the super deduction? E.g., is it vehicles and leased plant and machinery? Are they subject to any restrictions? And Matthews asks, is there a list of eligible capital allowances? So I think, yeah, capital allowances is a key
it's a hot one. Hot topic. Super deduction is right. I mean, I think quite clearly cars are out. The way I read it was anything that qualified for capital allowances at the rate of 18%. Which would mean that it would be any plant and machinery, it would be commercial vehicles, it would be laptops. It's going to be quite a wide range. I tried to find the Treasury document last night that gave some more detail, and I found the cover of it, and I couldn't find anything else. So I think we're just going to have to wait and see. But there will be a prescribed list, and it will give you a guide as to how you move from super deduction to the annual investment allowance or vice versa.
I think certainly they've said there'll be some anti-avoidance legislation around it. As with anything that's quite a generous relief, there'll be some detail of the anti-avoidance. I think there's, again, some restrictions around assets that are being bought on HP as well. So it's not that they won't qualify, they're just going to have to be a sort of fall within the right sort of HP, I think, to qualify. Yeah,
and that distinction has largely been there anyway in relation to the distinction between finance leases and HP. So it's nothing unusual.
Okay, but again, sticking with the super deduction, does the spend have to happen on or after 1st of April? We're about to finalise £1 million new plant spend for 31st of March.
I think the answer to that will be yes. The expenditure will need to be incurred after the 1st of April 2021. So I'd stop answering the phone and go and live in a cupboard till the end of March.
Okay. And a question on the stamp duty land tax residential nil rate band. Is it 125,000? Is it not rising to 175,000?
I think the way I read the budget speech was that it's 500,000 up until I think the end of September. Is that right, Zoe?
I think it's 500 at the end of June. It then drops down to 250 up until 30th September. Yeah, and then I think it does drop down to 125.
I think so. I put 1st of October normal rates, so 125,000. I think that's right.
Yeah. Okay, just checking the list. I think. Oh, it's one on the chat. Sorry. Can the self-employed still claim 18% on cars? The
answer is yes. Yeah, no change on that.
Yeah, let's want to look at electric cars. They have slightly better capital allowances.
Yeah, we get lots of questions on electric cars, and effectively 100% relief for expenditure on one. There's some quite high spec ones, which surprised me with the first questions we got on the super deduction. Can I buy a high spec car and will I get 130%? The answer was no, but it was nice to be asked.
I can't see any more questions at the moment. I don't know if anybody's furiously typing away. Last one in.
So thanks all for your time and sort of supporting us on this presentation. I hope you found it interesting and giving you a sort of a view on what was announced yesterday. We have recorded the presentation, so it will be placed on social media channels, YouTube, TikTok, or whatever gets posted on these days. I hope it's not TikTok. But obviously you can contact your usual BHP relationship to talk through any of these. And as I say, I think the takeaway for me is that as soon as we've got detail on the super deduction, we'll get it out there. And really give you some finite ideas as to how it's going to work and how it relates with the AIA. Just don't know at the moment. I've not seen it written down, and it wasn't in the press release or the tax impact note, but we will do. So other than that, I will say thank you. There's the normal disclaimer, and have a good rest of the day.